it's been a decent quarter. What's more impressive is that despite the uncertainties surrounding the IT environment, the guidance for the next year is very healthy. They need no introduction, but CVK and Anil Chalana are with me. And gentlemen, thank you so much for joining us on BloombergQuint. This is our first interaction. So, well, in a sense, welcome to this facility as well. Sure. And thank you so much for joining in today. But this is more about what you've done in the quarter gone by, more about what you will do in the year. And CVK, as much as I would want to dwell on what you've done for the quarter, and it's not been a bad quarter, maybe a couple of things that I'll ask you about. The question that is foremost on my mind is that how is it that you are forecasting the kind of growth that you have despite the clouds surrounding the industry?
Yeah, so thank you, Neeraj. And if you really look at the FY18, a little bit of what happened and what helped us in FY17 would be very helpful because that trend continues into FY18. If you look at our overall revenue growth, close to 12% on dollar revenue terms, pretty much higher than the industry peers, very good growth. If you have to look at the next level of theme, I think what is helping us is acceleration of our evolution into a next generation technology services company. That is the core driving factor which is pushing up the growth.
So it was already doing well and now it's accelerating.
Accelerating, exactly. Okay. And then the proof points for that is if you look at our mode 1, 2, 3 strategy, I had said that our mode 2 and mode 3 services will need to keep increasing every year. Sure. And this year, if you see between FY16 and FY17, mode 2 plus mode 3 has grown about 31% year on year. Okay. And I think that's the pivoting factor which is helping us grow. And these mode 2 services are digital and analytics, IoT works, cloud native services, cyber security, products and platform. I think these are the elements which are significantly moving the needle. And if you look at the last 3 quarters, we've done several initiatives to gain higher mind share with our clients in this mode 3 and mode 2 services. For example, 62% of our top 150 customers are consuming our mode 2 services in some form or other. Okay. Some as large programs, some as pilot programs. So basically there is an increased acceptance of HCL as a next generation services partner in our client landscape. So
some of these were already clients of the traditional services and they've accepted the mode 2 and the mode 3, which are the new age services that you're giving to your clients. Yeah. Bit of a cross selling happening.
Yeah, so actually if you look at it, when I kind of gave you a commentary earlier, we really want to remain relevant to the client so that we can capture the spend on the new areas. Right. While they start spending less in the traditional areas, how can your strategy be aligned to be more relevant to the customer and your propositions are rich enough so that they kind of divert the spend which is getting optimized on mode 1 to mode 2 and they continue to spend with HCL. Okay. So that whole strategy is very, very client focused, be relevant to the client, maintain or increase the wallet share from the client by enhancing the mind share on new services. Okay. That's really the strategy.
Great, seems to be paying off. Anil, my question is, I briefly remember while I was coming en route to the office that there is some mention of you losing one client but gaining a few others as well. What's been the client situation in the quarter gone by? Or maybe you want to dwell on the year?
No, there is no hiccups at all. No hiccups at all, I would say. Okay. It has been a very good quarter and I've seen in terms of 4.1% reported growth, 3.8% in constant currency terms, and even the year, we just discussed, has been a 13.7%. It's a very good growth. Okay. There are absolutely no hiccups.
Okay, just a bit of a rewind before we move on to FY18. IMS this quarter, the numbers that have come, is it a one-off and is it happening due to certain specific factors which will change in the first quarter or the next couple of quarters?
IMS overall, if you see from a year-on-year basis, it's grown 25 to 30% range, which is really one of the best performance for IMS in the many years. Yeah. Right? Actually, Neeraj, I want to just bring your attention to one aspect, right? We're increasingly seeing blurring lines between application and infrastructure services, right? And I think overall customers are, let's say look at a digital program where customer wants to refactor applications and move them to cloud. So you need the modern application development capability and the cloud migration and the cloud adoption kind of capabilities will need to come in. So it's becoming difficult to distinguish infrastructure revenues and application revenues.
So the street is obsessed with these numbers. How will you communicate
and
these?
that's exactly why we are communicating in mode 1, mode 2 and mode 3. And I think the right way to look at an IT services business in their journey to become the next generation company is to see how is the needle moving on your mode 2 and mode 3 services. What we call as mode 2 and mode 3, I'm sure others call it in different ways. I think that's the right way to look at it, not to look at infra and apps, because if you look at a CIO budget, he is not looking at can I optimize an infra, can I optimize an apps. He's looking at how can I use all the new technologies to refactor and rewire his applications, which means there is an infrastructure layer, there is a business process layer. So all of this needs to be looked at in one bucket. Otherwise, we will get it wrong.
So are you saying that had it not been for apples to apples, infra has actually not shown a poor quarter? You think it's been in par with the other quarters?
I think from a customer spend perspective, I think we are pretty much growing from an IT
and growing
landscape.
at a good pace.
Yeah, that's right.
Okay, fair call. Now, Anil or CVK, whoever, my analyst Agam had a very pertinent question. Manufacturing, which is quite sizable for you, you've shown a growth of I think 17% odd in FY17. With the growth numbers that you forecast, 10 to 12% constant currency, what is the quantum of manufacturing growth? If you can again speak about this in traditional parlance, I don't know if this gets blurred again, but do you think that quantum of growth is possible to reenact in FY18?
I think in FY17 manufacturing, obviously, we announced a very large deal with Volvo. Obviously, that helped in significantly enhancing the growth. Moving forward, I would think manufacturing would grow at pretty similar to our company average kind of growth rates. But if I were to call out, there is a lot of mode 2 spend in manufacturing, right? Like cloud migration, cloud adoption, that is gradually increasing. Right. The second element is if you look at supply chain and some of the core functionalities, horizontal functionalities in the manufacturing world is getting significantly enhanced due to digital. Right. So I think the mode 2 is a very good the target segment for mode 2 is manufacturing is a great segment, and that will drive some growth as well.
Okay, Anil, margin guidance is 19.5 to 20.5. There's a ever so little revenue guidance, slightly lower than what the street was working with. My question to you is, so despite the revenue numbers probably not as high as what the street was anticipating, the margin guidance is at those levels. How will you achieve it? Would you need acquisitions in the year or other levers to help this margin, or is this par for the course which will come about with normal business?
So I would say this will come with the normal business. So if you look at last year FY17, the dollar rupee rate we realized was 67 to a dollar.
Right.
And we gave a guidance of 19.5 to 20.5. We achieved the upper end of the guidance, which is 20.3%, 20 bips higher than the last year. This year, I have instead of 67, I have used 65.5 because this is what we are doing for our internal budgeting purposes, and which means I have actually enhanced my guidance on the margin front. So I think all the elements are in place so far as to deliver this margin. Don't think any inorganic initiative is needed for that purpose. But inorganic is a part of our strategy, and also whatever we have achieved, which is at 20.3 and 20 this quarter, is after factoring in that acquisitions which came at a margin which is lower than the company level margins.
Yes, of course.
So that's how we are not even going forward breaking, between the organic and inorganic.
Yeah, no, but my question is, if you indeed, because I know that you guys are on a prowl always, right? Every time that we speak, you have an acquisition or the other, and some large, some not so. Will you be able to maintain this range irrespective of a large acquisition that you may do? For all CVK might not tell me that they are that you guys are on activity, and you will announce something 10 days hence. So which is why my question to you.
I think the guidance is a achievable number, looks like, yeah.
So no issues on that front. Okay, what about hiring plans, either of you?
Of course, since we are growing at 14% year on year and our outlook is positive, and even last quarter we hired about 5,000 people. Some of it came from the acquisitions that we did, but organic hiring as well is good. So I think even in FY18, I do believe some of the demand that is going to come is going to be fulfilled by new hiring. So I think the trend would be pretty similar to what we had in FY17.
Okay. You've pretty much had non-linear growth because I don't think your employee hiring has kept pace, or you've not let it be at the same levels as your revenue growth is. Now I also hear that you are making a lot of centers in the tier 2, tier 3 cities in India as well, domestic work. Now is this a conscious strategy to ensure that your wage costs do not dramatically go up, or do you believe that there is potency out here for other reasons, which is why you're doing this? This may not be a big number, but I'm still just getting it.
The non-linearity is primarily, if you see the headcount has grown as about 7% CAGR over the last 4 or 5 years, while revenue has grown 12-13% CAGR over the last similar period. I think this is mostly attributed to, we have a large percentage of managed services and time and material is less, fixed price managed services is over 60-61%. And this lends itself to automation. Our dry ice autonomics platform is implemented in 200 plus customers. So that is helping this non-linearity between the headcount growth and the revenue growth.
And attrition probably is not a concern?
Attrition has definitely come down. In fact, we are happy that our whole engagement strategy, our investment in training people, we trained over 22,500 people in new generation technologies for cross-skilling, upskilling, all of that in the last 12 months. And I think all of this is reflecting in lower attrition. And from a year-on-year perspective, about 160 basis points reduction in attrition. I think we are pretty heading in a very healthy direction there.
The sector was plagued the last 24 odd months by, and rightfully so, with companies believing that they will grow at a particular pace and then eventually not being able to because the situation was very fluid. Yeah. You don't foresee that situation. This guidance, as things stand, you certainly believe can be conveniently attained.
Obviously nothing is so convenient in an industry like this. So,
yes, no, but
I think, basically, if you have to give a guidance for a full year, you have to look at your order book, you have to look at your pipeline, you have to look at your conversion ratios, how much you will be able to execute. As it looks today, I think it looks achievable.
The reason I asked this because Gartner has downgraded from the previous 12 months.
Little bit it is reduced, I think, if that is at a macro level, I think client spend is maybe marginally reducing. But I think if you have the right propositions, if you look at your universe of customers, and that's what plays into our guidance. So,
my last question to either of you. I remember 12 months ago when we did an interaction, or 24 months ago when we did an interaction, one of the interesting things that we bumped upon was the things that at times an IT company CEO or CFO have to do, not in order to win deals, but while winning deals, you blend with the local culture. So I remember Anant telling me that he had to take a helicopter ride in freezing cold. Some years ago, Vineet had done that as well, and I'm sure you were involved in a lot of deals. Anything interesting that you guys have done in the last 3 months in order to sit down with a client and do this?
I think nothing to call out. There's lots of travel, and we spend more time on the flights.
More miles than a pilot?
Maybe for some type of pilots, I guess, but lots of travel, and it's a global kind of coverage. So that's probably what it is.
But it's a healthy conversation that we are having for your next 12 months, and I'm sure we'll keep on doing this as the months go ahead. But a pleasure chatting with you, gentlemen, and thanks so much for joining us on BloombergQuint for the first time.